Hello and welcome to Maximising Opportunities in the Current Property Investment Market with Bridging. A nice mouthful first thing in the morning there for you all. But yeah, I'm Steve Smith, Sales Director of Roma Finance. This is going to be recorded, so as I go through, please ask questions whatever you want. It's just very relaxed, so just ask any questions that you need or wait till the end and we've got time for questions then. We've put an hour in. There'll probably be 20-30 minutes of me waffling on this, and then any questions you've got or any questions, as you say, as you go along, that's absolutely fine. But yeah, we're going to talk today about opportunities in the current property investment market. Obviously, the climate is a little bit strange at the moment. We've had a lot of negatives. You've only got to open a newspaper, read the news. We've got a lot of negatives, but there are lots and lots of opportunities out there in the property investment market right now in the UK. So people may come and go in. I'll just start, and then as people come in, just ignore them and we'll just carry on and people can catch up, and we can send out the slides if we need to, and we'll put this video up on our website as well. Okay, Natalie, if you could go next slide, please. So the past 3 years has created a turbulent property market, as we know. We've had, obviously, COVID, we've had Brexit, and we're still suffering a little bit from Brexit. You've only got to look at, shelves of supermarkets to see that. And obviously the war in Ukraine is not helping anything at all. So you're looking at sort of throughout those 3 years and that problem in the market, we've still got a lot of good, positive vibes going in our UK market. You'll see that, people are talking about, oh, property prices are coming down, but we've had so much property prices going up for so many years that there's really good opportunities in this investment market right now. And investment is probably the key word, because the flip sales are sort of going in, buying something, doing up a bathroom and selling it. You're probably not going to make a massive profit right now. But if you leave it for investment and get onto that investment ladder for sort of even really a year, and we'll see that bell curve of the sort of the Bank of England base rates coming down again, hopefully, and I am touching wood when I say that, but they should come down again in the next sort of year even. To keep hold of an investment property for 1, 2, 3 years could be a really profitable thing to do. So property prices, as we're seeing at the moment, we're seeing serious property investors coming back into the market, and they haven't been around for a few years now. They have, because the market has been so easy for all of us to play in. To be honest, with property prices going up, everything, mortgage rates being so low, rates for bridging and sort of term loans so low, it's been a really good place for us all to play. But obviously that can't last forever. And we're now in a position where, some of the property prices are coming down, especially in the commercial sector. So what we're seeing, especially at Roma and across the board, really, according to things like the bridging and commercial and nationwide, we're looking at sort of commercial properties coming down in price, especially if they're in sort of areas like offices. We're now sort of after COVID, there's a lot of home working, there's a lot of hybrid working. So people aren't really investing in those big offices anymore, especially outside London, that we're seeing. And also shops on the high streets. We know our high streets are changing rapidly. We're seeing a lot of coffee shops, we're seeing a lot of sort of semi-commercial properties, and a lot of the things like Woolworths, all of these big firms have gone, and sort of a lot of their spaces in the sort of centre of towns have gone as well. And a lot of these are being now changed, and the change of use is coming back to sort of semi-commercial or residential. So we're seeing property prices are expected to reduce 5 to 10% this year, but as they've increased pretty much up to 50% over the last few years, they're still a really good investment. And if you can keep them beyond 2023, which is why we're talking about investment more than sale and flip today, the long-term forecasts show that there's increases again by the end of the year. So property prices will go back upwards. And then you look at sort of mortgage interest rates, which have obviously gone up drastically over the last sort of year. If you look at the 5-year forecast for our loans, even though the Bank of England base rate went up again recently, the overall 5-year sort of forecast was that it's coming down. And so we know that there's a bell curve. We know there's a bell curve coming on the interest rates, and we know interest rates will come down fairly soon. There may be one more slight increase, and then we'll see the top end of it, I think, and it'll start coming down. Now, what it comes back down to is a different matter, because we think probably, the days of 0.5% and 0.1% are definitely gone, I'm afraid. And that affects all of us, obviously, but I think we'll probably see it coming down to 3.5%, and probably staying at that level. So we have to look at sustainability. And if you can get something 3.5% as a rate on your property that you've increased in value, obviously rental income can be more than that. And once the sort of this year's gone out and the sort of the volatility in the market has come out somewhat, we can then look at again selling properties again and making a profit probably from 2024. So mortgage rates, as I said, they've almost hit the peak. They're beginning to show signs of coming back down. We've seen a lot of lenders that are doing sort of 5-10 year forecasts. They're a lot lower. It's only really your immediate sort of this year tracker mortgages and that are sort of high. We are seeing a lot of sort of pain in that market as people sort of come in, because obviously every passing month there's thousands more people having to swap and sort of remortgage. I myself at end of 24, so I might be okay when I need to remortgage mine, but I certainly won't be getting the 1.99 I'm on currently. So we're all in that same boat, but that doesn't really, as long as it's sort of, it calms down a little bit, which it will over the next year, and certainly over the next 5 years. It shouldn't affect the investment value of the properties so much. It's just the rates that you're having to, if you're going to rent out, you rent more than your mortgage. That's just the way it is, and that's how you make money. So it shouldn't make too much. There's a lot of money out in the mortgage market at the moment. There's a lot of mortgages out there. All of the sort of drama and trauma of last year has sort of calmed down. We're back on a more even keel, and although it's slightly higher than we'd all like it to be, that will be coming down very shortly. So what are the government doing about it? Well, that's probably a different matter, and depending on your political views, and let's not go there. But I think the government, they're starting to make it easier for property investors to develop change use and refurb, especially the change of use. We see now a lot of people, as I said earlier, commercial to resi is a big thing. There's also sort of semi-commercial to resi as well. And sort of we're seeing a lot of sort of these places, especially in town centres or on the suburbs of town centres, being changed into semi-commercial. So what might have been an office or what might have been sort of a storeroom above, they're being made into, money-making properties, so a rental income that can come in. So we're generally seeing a lot, and we are seeing a lot of this property refurb stuff, especially from commercial. Sometimes it's commercial to commercial. Just for a different use, not a retail unit, for example. It's becoming sort of something like a restaurant or a coffee shop. We're seeing a lot of that, but we're also seeing huge amounts of sort of going from semi-commercial or commercial to purely residential. So we're seeing on the high streets now, we're seeing a lot more actual apartments and townhouses and such like, and that will probably continue as we change, as the internet's changed all of our standards. COVID has changed the way we live. There's a lot of sort of more out of area retail parks where people go shopping, free parking, we all go to them. And then basically you've got then in towns, the towns are becoming more a sort of younger hub, I think is probably the way I'm seeing it in places, certainly around in the southwest where I live. But sort of you're sort of getting that vibe back into that, where it's more of a bars, restaurants, clubs, coffee shops, and sort of independent retailers. There's a lot of that going on in these smaller town centres, which isn't a bad thing, because investors will come in, property developers will come in, pick up reasonably cheap properties, and change of use is very easy to change and develop and then refurb. So the rise in commercial to residential is creating a lot of opportunities. So we're seeing the commercial properties in town centres becoming available, but we're also seeing a lot of these going into not just simple buy-to-lets, but they go into HMOs, they go into coexistent living. So coexistent living, for those that don't know, is the new trend. It seems to be going on a lot down on the south coast. Certainly there's actual sort of HMO and coexistent providers down there, developers specifically in places like Portsmouth, Brighton, Southampton. And basically it's for those students primarily that come out of university but don't want to go back to live with their parents. So they're actually living with 1, 2, 3 others in a space, and so they share completely all of the bills. And the only things that they really seem very important to them are huge amounts of sort of Wi-Fi and huge amounts of parking. They're not too bothered by the garden spaces, and they're just not too bothered about sharing kitchens, bathrooms, and all of that. So slightly different from a HMO. It's a little bit more like, I suppose, your student sharing type accommodation, but in an adult world. And we're seeing a lot of that, because obviously sharing the bills these days with electric, gas, etc., is quite attractive to somebody in their early 20s who are just coming out of a university situation or just leaving home. As we've got there as well, hotels, pubs, care homes, clubs, a lot of these are being changed into resi or semi-commercial. HMOs are still popular. There are still a lot of HMOs being built. You can make a lot of money from HMOs, and buy-to-lets. You know, there are a lot of families now that can't, for whatever reason, get a mortgage. They've got jobs and they can certainly rent quite happily, and maybe they want to. We're changing society now. We are a little bit more like Europe, where you don't have to own your own home. People are quite happy to rent where their job is, you know, closer to a town, you know, negate that need for a car, negate that need for various things. They'll rent, and then if their job get an opportunity to move, it's much easier for them to move and go and rent somewhere else. You know, it's a different type of society now, and there are lots of different people out there that want to do different things. So don't just automatically decline a buy-to-let opportunity because you think HMOs are going to be, you know, make more money. Potentially, yes, but buy-to-lets, you can, if you get a good buy-to-let in a good area for decent money and you get a family in there, they can stay there for 2, 3, 4, 5 years paying good rent month on month. And coexistent living is probably something that you'll hear a lot more about. A year ago, probably didn't hear about it at all. It's now pretty much all I hear about from the property developers that used to do HMOs. So it is something that you need to look at and probably advise borrowers who are looking at doing it as well. There's a market for that, a big market where people will quite happily live with each other side by side. I think for everything, especially in times like these, the times have been quite difficult. Hopefully, they'll start calming down. I think they are in the markets, full stop, and certainly in the government and the relationship with the providers of mortgages and term loans and bridges. But I think the relationship between the property developer and the lender is really important, whether that's the property developer with the broker or the broker with a lender, whatever it is. But it's all about relationships because everybody wants repeat business. As a broker, you want repeat business with that developer or that customer. As a lender, we want repeat business with a broker, and the relationship works well. Once you've done that first deal with a company or a person, it's much easier to then do the second, third, fourth deal because half of the search has been done. We're comfortable with that person or that company, so it's much easier to then get the next deal done. And we are really doing a lot of repeat business. Repeat business is now at 40% of everything that Roma do, and we want to increase that. It's increased year on year since I've been sales director, certainly the last 4 years. And again, we'll continue to increase that. Repeat business is really good because it's easier business as well for all concerned. The broker gets their commission easier and quicker. The developer gets their deal done easier and quicker. We feel more comfortable because we've got a property lender developer at the end of that line that is successful and goes for repeat business. And that's what we all want, really. So our products, for those that don't know Roma that well, we do a whole range of products. So we do obviously auction finance, bridging finance, your standard vanilla bullet loan bridging finance. We also do that with the residential market. We do it with semi-commercial, and we do the fully commercial market. We do all types of refurbishment bridging finance. So we do light refurb, medium refurb, and heavy refurb. And how we break that down is basically a light refurb is up to 50% of the value of the property. So if you're buying a property from an auction or estate agent or privately for 100,000, if you're going to spend up to £50,000 doing whatever you're doing to that property, it's classed as a light refurb with us. If you're doing 50% to 100%, so if you're going to say spend 80,000 on it and you bought it for 100, that becomes a medium refurbishment product for us. And it's only a heavy refurb if you're actually going to spend more money than you've actually bought it for. So you bought it for 100 and you're going to do 150 grand's worth of work on it. It is a heavy refurb model. We also do full-on ground-up development finance. So basically, buy your piece of land, get some planning. We can then develop it from scratch for you. We can also do that residentially. So it's not just commercial or semi-commercial. We can actually do development finance for commercial, semi-commercial, and residential. We can also do all of these things in England, Wales, and Scotland. And we also have a limited term loan offering, which basically covers off our own buy-to-lets for our own bridges that go through. That sort of, we can also do that as standalone, and we can use holiday let, serviced accommodation, and buy-to-let standard as well. That's only for residential. That's not for commercial on that side. But our vast majority of our products and the vast majority of our business, especially now, is roughly 50% your auction, simple bridging, and 50% your heavy refurb developments. There's a lot of that going on, and we've got no problem with that whatsoever to do that. And we sit within the anything from £50,000 lend to up to 3 million lend. So it's a big market for us across the UK, not Northern Ireland, but certainly in England, Wales, and Scotland. We can look at all of those products. So Roma Flow, you may have heard of this. Charlotte and Natalie in our marketing department get this out a lot. This is just for your sort of light refurbishments and your sort of real light touch, vanilla, simple auction purchases it was made for. But we can do it for any private funding or sort of estate agent purchase. It's basically a soft touch underwriting, intelligent touch underwriting, and reduced document requirements. So from the customer or broker, we're looking at just a signed agreement in principle and a signed application form. We'll then do a home track, or we'll do a valuation. And if there's any kind of works being done, we'll need a schedule of works, and that is it. You know, basically we'll instruct. We'll either do the home track, so the sort of actual electronic valuation straight away, same day, or we'll instruct the valuation the same day. We'll also instruct solicitors within 24 hours. You get a dedicated underwriter, but you also get a dedicated case processor who can talk to you about where you are at any one point. We use cutting edge technology, so we use things like an app called Credas, which means that you don't have to do ID. It's an app on the phone that will basically take a photo of you, and it gets all of your relevant information of passport, bank statements, all of that. We also do open banking, so you don't have to send bank statements through. And by doing all of this, it's an easier process, for the customer and also for the broker. And these things are done very, very quickly. And at the moment, just over 80% of our cases that go through this are completed just in under a month, so within 28 days. And at the moment, I think we're on to, as a bridging nation, if you like, about 54, 55 days. So that we can do over 80% of our Roma Flow cases within the month is pretty good in the marketplace right now. We also accept electronic signatures. So again, all of these things we do just to try and make the process easier. And when you've got an auction purchase specifically, although you can have a speedy purchase for just a purchase full stop, private or through an estate agent, it's really important that we do these things quickly, and the whole process is easy for A, the broker, but B, the actual ultimate borrower. And I think by doing this, and this is something that has been really, really successful for us, we launched it probably best part of 18 months ago now. It's been hugely successful. It's now probably pushing 50% of our business, as sort of the market understands that we can really deliver these 28 days as a sort of SLA, and it's working really well. And again, what we do is we look at, if the only reason we'll need bank statements or we'll ask for any further information is if the credit report is poor or it shows up that there are issues, and we'd want to have a look and just get under the skin. Doesn't mean to say we're going to decline it. It just means that we want to have a look a little bit deeper and make sure that obviously everybody can afford what they're actually going for in a sort of, you know, financial arrangement. But Roma Flow, if you ever hear of it, it is for your sort of your bridging, your auction, your light refurbishment on your residential properties. We can't do it for obviously your full-on developments, and we can't do it obviously on sort of, you know, looking at things like sort of commercial units or semi-commercial units. But for your standard, very vanilla bridge, Roma Flow is the way to go for us. Below market value. Now we've got a specific below market value property now just come out. This is quite new, and probably just because we've looked at the market and seen how the market is. With sort of the market has been quite, you know, it's had a difficult year. There's no getting away from that. But as it's calming down, we've seen a lot of the proper real property investors come back into play and come back in quite a major way, picking up properties. Now, there's a chance that they can pick up properties a little bit cheaper because people might have been distressed, or people might not be able to afford mortgages. Rental income might have gone up, so they've moved out. And especially with people who've probably got one property and it might have been their pension plan, or it might have been their first attempt at this, they're probably looking at it going, you know, it's easy if I just let it go now. So there are opportunities out there where people will buy a proper property just at a below market value price. And what we can do with this is, and this is basically looking at 90% of the gross value. So looking at what it's actually going to be, the purchase price is not up to 90%, as long as it's within 70% of the actual loan to value itself. So we look at basically, it's a mathematical equation. So you look at the property and you go, right, what's it actually worth? And a value will tell us that. And so we're looking at happy with that. And then we'll look at sort of, you know, so we'll go, what's it worth? Well, it's worth, I don't know, 150, but they're actually going to pick it up for 120. So again, we can give them more purchase price because obviously the value is worth more. So it's a little new product. It's going to be, we've already seen quite a lot of take up on it, and I think it only works when there is a true below market value property, obviously. But as the market's changed slightly, and sort of as a show of what we actually do, we look at the market regularly, and we look at sort of trends in the market, and a little bit like the co-living situation, which is becoming, more and more popular. We're looking at a below market value one as well. And the below market value one, we can lend in Scotland, but in Scotland we need a comfort charge or additional equity. In England and Wales, it's absolutely fine, and we'll do it sort of up to 500k. So it is for your smaller residential purchases generally. We can look at those and actually just do, standard construction properties only. So there's a few sort of but if you've got a standard property that is being bought below market value, this is a really good opportunity to get in there and do it for you. And that is pretty much it. So I've flown through that in about 20 minutes, and that was always the case, really. It's quite a small sort of opportunity to have a discussion with you. But what we want really is, if there's any questions, by all means, you've got that is our head office number, which takes you through to sales, underwriting, or customer services. The inquiries at Roma Finance will click into our sales support team, and our website sort of has a lot of this. Well, it'll have this video and other videos on there, and it has all the information about contact details for all of the BDMs that I run across the country. As I say, my details are on there as well. So if you do have questions after today, please just drop me an email, drop me a phone call. Quite happy for that. It'd be great to work with you. And I think, any questions you have, I would go back to the relationship style. It's like I've got BDMs up and down the country in every geographical area. I've got sales support staff. There's 19 of us now in the sales team as a whole, including marketing, at Roma. So please give us a bell, have a chat. If you've got any questions at all, let me know now. But equally, if not, drop them in the email to inquiries and we'll get back to you straight away. So I'll stop it there. I'll stop talking, because talking to yourself is very weird on these things. And I've been talking non-stop for about 21 minutes now. So if you've got any questions, give me a shout. If not, very happy to be working with you. Come back to me or one of my BDMs in the next few weeks.